Is the cryptocurrency market a card house that could collapse at any moment? And if so, what's underneath the card house? Well, if you tuned into the first video of this series, we know it may frightfully be yet another card house. Hello, I'm Crypto Casey, and this is the second video in a three-part series where we will investigate whether or not the cryptocurrency market, as well as the entire global financial system, is indeed on the verge of collapse. This is a beginner's guide where we will break down step by step how the cryptocurrency market is structured, what stablecoins are, their role in the cryptocurrency market, and why stablecoins will both drive massive global adoption of cryptocurrencies while also potentially threatening mass adoption of cryptocurrencies. Our goal by the end of this video series is for us to understand the traditional financial system's relationship with the cryptocurrency market, and if a crypto collapse can happen, how and when it could happen, and what we can do to protect ourselves as investors in this space. If you haven't yet, click on the link above to check out the first video where we learn about the structure of the financial system and how it's the foundation upon which the crypto markets currently operate. Awesome, let's hit video 2. Just a quick recap for a more seamless transition between the first video. Currently, the crypto markets are highly correlated with the traditional markets, and on an abstract, conceptual level, the crypto markets are still utilizing the traditional global financial system as a foundation. And here's a visual representation of the current state of the US financial system. An inverted or upside down card house. The lowest rows representing less risky assets, and the highest rows representing the most risky assets. From bottom to top, we have a few real treasury bonds. Above those, we have rehypothecated bonds and real estate. Then mortgage-backed securities and commodities. Next, stocks, bonds, and equities. And finally, options, futures, and derivatives. And surprisingly, or rather unsurprisingly, it's a right-side-up card house, whose foundation is the traditional financial system inverted card house, which, when put all together, looks something like this. Fascinating, right? So let's break down the structure of the crypto market card house together in 3 sections so we can get a better understanding about the current state of affairs in the crypto markets. Section 1, stablecoins. So each cryptocurrency has a different function or utility, and types of cryptocurrencies that peg their price per token to something with stable pricing, like the US dollar, are known as stablecoins. For example, USDC and DAI, or DAI, are tokens that are pegged to the US dollar in that they maintain the same value as a US dollar. This makes the token price stable, staying at nearly $1 per USDC, which is why tokens with this function are called stablecoins. Stablecoins were designed for 2 main reasons. 1, to bridge the gap between fiat currencies like the US dollar, euro, or British pound, and cryptocurrencies with fiat to crypto convertibility. This allows people to transact between cryptocurrencies quickly and seamlessly without the multi-day lag associated with wire transfers of fiat between traditional banks. And 2, stablecoins were also designed to decrease volatility associated with holding most cryptocurrencies by allowing people with the token to hold an amount of crypto with less price fluctuation. For example, when you look at the price of cryptocurrencies like Bitcoin and Ether, you see how the prices are constantly in flux. One day Bitcoin can be worth $30,000, and the next day it can be worth $35,000. However, with a stablecoin like USDC, you can hold $10,000 worth of the cryptocurrency, and minute to minute, day to day, the value will be representative of the US dollar and remain relatively unchanged, which gives stablecoins like USDC a lot of utility in the crypto market. This greatly facilitates trading, lending, and borrowing in the cryptocurrency marketplace while also providing massive amounts of liquidity. Stablecoins allow for fast, efficient tradability of crypto, which leads to high liquidity. What is liquidity? Liquidity is just a fancy finance term that describes the level of activity in a market or how many people are buying and selling in the market and at what frequency. So high liquidity in crypto means cryptocurrencies in the marketplace or exchanges are being bought and sold frequently and fast before much price change occurs. Bitcoin is an example of an asset with high liquidity, as when you buy or sell Bitcoin at market price, the transaction happens instantly because there are a lot of buyers as well as sellers in the Bitcoin market. So you can sell your Bitcoin for cash instantly pretty much on exchanges with high liquidity like Crypto.com or Coinbase. And stablecoins are one of the main reasons that the crypto market has a lot of liquidity due to the fiat to crypto convertibility and the decrease in volatility they provide for investors in the space. There are several different stablecoins currently in use, but the largest, most popular, and pervasive one is Tether, or USDT. which brings us to the next section. Section 2. Tether. Tether is a stablecoin that was founded in July 2014 by Brock Pierce, Craig Sellers, and Reeve Collins. Originally, Tether was created as a cryptocurrency fully backed one-to-one by bank deposits of real US dollars. But as time went on, that intention couldn't be farther from Tether's current reality. Let's briefly touch on Tether's business structure before exploring the many uncertainties and scandals that plague its history and taint its current reputation. There are 4 main entities that make up Tether's business structure: iFinex, Bitfinex, Tether Limited, and Tether Holdings Limited. Bitfinex is a cryptocurrency exchange that was founded in 2012. And a couple of years later, in 2014, Bitfinex set up one entity called Tether Holdings Limited in the British Virgin Islands and another entity that is a fully owned subsidiary of Tether Holdings Limited based in Hong Kong called Tether Limited, which was created to issue the Tether tokens. The following year, in 2015, Bitfinex enabled trading of Tether on its platform. And during that time, Tether and Bitfinex representatives deceptively maintained that Tether and Bitfinex were completely separate, unrelated entities. It wasn't until 2 years later, in November of 2017, in the Paradise Papers leak, that the creation of Tether Holdings Limited in 2014 was revealed. So the owners of Bitfinex control both Tether Holdings Limited and Tether Limited. And as if it couldn't get even more convoluted, an investigation found that an entity called iFinex is the main operator of both Bitfinex and Tether. Nice. Now that we know more about Tether's origin and suspect business structure, let's go through some of its scandals that further damage its reputation. Since its inception, Tether claimed that each Tether token issued corresponded with and was backed by one equal real dollar in a bank account. It wasn't until March of 2019 that Tether admitted its underlying assets also included loans to undisclosed affiliate companies. And a month later, in April 2019, Tether's lawyer revealed that only 74% of the outstanding Tether in circulation was backed. That same month, New York Attorney General Letitia James filed a lawsuit against Bitfinex, alleging it used Tether's funds to try and cover up $850 million worth of missing funds since 2018. Further investigation revealed that Bitfinex was unable to create relationships with traditional banks, so instead they started using an unlicensed payment processor called Crypto Capital Corp, which unfortunately ended up stealing funds. iFinex, the operator of Bitfinex and Tether, lied about Tether's backing and the relationship between the two companies in an attempt to hide those losses. And there was yet another scandal that surfaced around the same time during the previous bull cycle in 2017. Bitfinex and Tether were accused of manipulating the price of Bitcoin. Research shows that increased amounts of Tether printed into circulation associated with trading on the Bitfinex exchange accounted for about half of the increase in Bitcoin's price. So was 50% of the price increases we experienced during the last bull cycle all because of the orchestrated creation of Tether token printing? Well, wait, there's more. In addition to price manipulation, Bitfinex was also manipulating trading volume at that time to make it look like more trading activity was happening in the crypto market than there actually was. Research found that small orders were moving the price as much as large orders, with lots of oddly specific order sizes. Order sizes so specific, mind you, that they went out 5 decimal points, and these orders were repeated over and over again with high frequency. This begs the question of whether or not we can even rely on the historical price movement of Bitcoin from the last bull cycle to predict how the current one will unfold. But that question warrants its own separate video altogether. Either way, shady AF. So, in a settlement this past February of 2021, Bitfinex and Tether agreed to pay a penalty of $18.5 million and provide quarterly audits of Tether's underlying reserve assets. Nice. Finally, a slap on the wrist and forced oversight that will put all of our minds at ease, right? Ha, wrong. The first audit Tether produced was quite alarming. A single-paged PDF consisting of merely 2 pie charts without any of the data used to create said pie charts. The document is titled Tether Reserves Breakdown at March 31st, 2021. Wow, not even a proper preposition. At March 31st instead of on March 31st. Below it on the left, we've got one big blue pie chart, and below the pie chart, the following breakdown. 75.85% of the chart consists of cash and cash equivalents and other short-term deposits and commercial paper. And there's a smaller pie chart to the right that breaks down this section in more detail, which we will circle back to in a moment. Next, on the big main pie chart, 12.55% consists of secured loans, none to affiliated entities, aka loans to God knows who for God knows what. Next, 9.96% corporate bonds, funds, and precious metals. Okay, cool, slightly less disturbing. And finally, 1.64% of other investments, including digital tokens. LOL. Part of Tether's underlying reserve assets are the very crypto it's likely artificially propping up price-wise, which we will break down in a later section, so hold on tight. Moving on to the second small pie chart to the right that breaks down the 75.85% section of the chart described as cash, cash equivalents, other short-term deposits, and commercial paper. All right, 65.39% of the chart consists of commercial paper. Comforting? Absolutely not. Commercial paper is literally unsecured debt issued by companies. Which companies? Who knows? None are listed. And I'm sure if they were big, rather robust ones like Google or Apple, they would have been proudly displayed here by Tether. And unsecured means there is no collateral backing the loans, meaning that if the companies don't pay back the loans, there is no recourse for Tether. It's just gone. Awesome. All right, next we have 24.2% of the chart representing fiduciary deposits. What are fiduciary deposits? Well, a fiduciary deposit is where one financial institution, called the fiduciary, places someone else's money in a second financial institution on their behalf. Why would they do that? If you look at Tether's track record, why not? Using fiduciary deposits, the ultimate beneficial owner doesn't have to be declared. Fiduciary deposits allow sophisticated investors to put money into banks they otherwise may not have access to due to restrictions. And fiduciary deposits, in many cases, allow a legal route around automatic reporting and exchange of information. Let's be honest. Do all of these qualities not scream Tether to you? Moving right along, next, finally, the gold ticket item we have been waiting for. Cash. Cash at, big yikes guys, big yikes, 3.87%. Wow. And bear in mind, this represents a percentage of a smaller percentage. According to this morbidly, massively oversimplified report, Tether, in all of its short, sketch-laden time of existence, admits to the entire world that the amount of cash it has on hand, backing all of the, at the time of this video, upwards of $63 billion worth of its Fugazi fairy dust Tether token, adds up to a whopping 2.93%. 2.93% of the amount of real US dollars Tether claims to have on this elementary school level pie chart that looks like it was whipped up by the likes of, maybe some especially savvy house cat, are held as reserves for the third largest cryptocurrency by market cap. Unsettling? Oh, just wait. This is just the tip of the iceberg. But first, let's get through this report, which I swear would not receive high marks in any grade above 4th. Seriously, this is some 4th grade level reporting here. They literally just used some template from Excel, input the numbers, chose the color scheme, and didn't even bother changing the font from the default Calibri. Look, there's not even a source or footnote information for these percentages, and there's not even any dollar representation of these percentages. We need an audit of the audit. And if it's just going to be this level of reporting, we're going to need an audit of the audit of the audit in ad infinitum. Let's ask ourselves, what was Tether's goal with this report? To buy trust or to buy time? Let me know in the comments below. All right, let's move on because this next item from the pie chart should pique your interest if you've survived the first video of this finance and crypto card house series. 3.6% of the chart consists of reverse repo notes. And using our newfound knowledge, we can deduce that Tether is borrowing some definitely rehypothecated US Treasury bonds with a promise to give them back at a later date plus interest, hence the reverse repo note. And the final piece of the pie, 2.94%, consists of Treasury bills, all of which are 1000% rehypothecated, I can assure you. Amazing. People are putting their money into Tether, borrowing against their Tether, lending their Tether, holding their Tether, leveraging their Tether, staking their Tether, trading their Tether, have buy and sell orders to convert crypto into Tether. All the while, Tether is basically doing the same very thing with their reserves. Gambling. Oh wait, hold on. Maybe we're being too hasty in our judgment. Let's see what others have to say. Criticisms of Tether's reserves are unfounded, says... Wait, who's this? Bitfinex CTO? Yeah, get out of town. That's basically Tether saying that criticism of their own reserves is unfounded. So just to recap, Tether, the most massive, pervasive stablecoin that is largely unstable, is sketchy because of its unclear relationship with business entities that were actually in control over it, that being Bitfinex and overall iFinex. These entities' manipulation of the price of Bitcoin by 50% in the last bull cycle, and their failure to produce believable, substantial evidence of their reserve assets, or rather, lack thereof. Excellent. Let's move on to the next section of this slippery slope. Section 3, lack of regulation. To illustrate how terrifying the Tether situation is, let's talk about how Tether and other stablecoins currently work in the crypto markets to highlight how lack of regulation is largely to blame for the creation of this ticking time bomb. When you deposit $100 into Coinbase and convert it into the stablecoin USDC, Coinbase credits your account with $100 worth of USDC tokens and takes your real $100, and they can either lend it, save it in a bank, use it to invest in assets, or use it to pay for expenses like payroll, office supplies, etc. On Coinbase, you can choose to lend out the $100 worth of USDC for up to 4% interest. Nice. Simple enough, right? An easy passive income stream. Set it and forget it. So what happens next? Well, Coinbase can lend your $100 worth of USDC tokens to another financial institution, like an exchange. So let's say Coinbase lends out your $100 of USDC to Binance. And some random customer named John on Binance makes a deposit of $100 real, then exchanges it for USDC. And Binance credits your $100 of USDC you lent to Coinbase to John's Binance account. And wow, what do you know? Binance is offering up to 7.12% interest for USDC. So John is like, oh snap, sign me up. And now the $100 of USDC you lent to Coinbase, that Coinbase lent to Binance, that Binance lent to John, is now being lent out to yet another borrower. This can go on in ad infinitum. Sound familiar? Like maybe if the fractional reserve banking system and the reverse repo market had a twisted demented baby, perhaps? The cherry on top of it all is there's no FDIC insuring any of it. Check out Coinbase's user agreement. Acknowledgement of risk. You acknowledge that digital currency is not subject to protections or insurance provided by the Federal Deposit Insurance Corporation or the Securities Investor Protection Corporation. USD Wallet. Your USD wallet allows you to hold and transfer USD with your Coinbase account as described below. In general, we will combine the balance of your USD wallet and other customers' balances and either hold those funds in a custodial account at a US FDIC insured bank or invest those funds in liquid investments, such as US Treasuries, in accordance with state money transmitter laws. Coinbase owns the interest or other earnings on these investments. Pooled customer funds are held apart from Coinbase's corporate funds, and Coinbase will neither use these funds for its operating expenses or any other corporate purposes. Okay, so your US dollars on Coinbase are held in an FDIC insured bank or invested in US Treasuries that have most likely been rehypothecated. Fine. How about that USDC we lent out? Coinbase's user agreement reads, USDC wallets. You may also elect to buy USD coin from Coinbase, a digital currency fully collateralized by the US dollar, which is issued by Circle Internet Financial, or Circle, and supported by Coinbase, USDC. You are the owner of the balance of your USDC wallet. Coinbase is not the issuer of USDC, does not hold US dollars on reserve for USDC holders, and has no obligation to repurchase your USDC for USD. You can redeem your USDC with Circle, and Coinbase may also elect to repurchase your USDC in exchange for USD. You agree to be bound by the terms of the Circle USDC agreement located at support.usdc.circle.com, which provides additional obligations, undertakings, and limitations with respect to USDC. Interesting. Okay, let's see what Circle says about our USDC we lent out. No deposit insurance. USDC held in your USDC account are not subject to deposit insurance protection, including, but not limited to, where your country of residence is the United States, the Federal Deposit Insurance Corporation insurance, or Securities Investor Protection Corporation protections, or where your country of residence is outside of the United States, the United Kingdom, Financial Services Compensation Scheme, or equivalent scheme in your country of residence. Okay, so this is the same situation for every digital stablecoin out there, including the largest, most pervasive one, Tether. There's nothing insuring them. No one owes you anything if the value drops, and if you haven't realized it yet, there's an extremely small amount of real dollars being used and held in the global cryptocurrency exchange and market ecosystem, Meanwhile, tons and tons of rehypothecated digital representations of dollar price value, or stablecoins, are running rampant without any regulation or oversight. I mean, check it out. It's not even a real $100 worth of fiat in an FDIC-insured bank account that is being rehypothecated via stablecoins. A $100 worth of stablecoins itself that is not insured at all and whose underlying reserve assets are unknown in addition to being unregulated are being rehypothecated. So why are the transaction fees so cheap to use stablecoins like Tether? And why are staking and lending interest rates so favorable for stablecoins like Tether? Well, isn't it obvious? The only ones taking the risk are the individual users like us. Not Coinbase, not Binance, not any of the exchanges, it's all us. But what about the entities like Tether and Circle that issue Tether and USDC tokens? Well, let's just assume for a moment that Tether's audit report looked and seemed reasonable. The trouble is that the third-party companies that sign off on these audits are like United States politicians, bought and paid for. These auditors can look and see, okay, you have $63.5 billion worth of assets and $63 billion worth of Tether tokens in circulation. Checks out. All good. Nothing to see here. Here's my signature and blessing for your audit. And oh, by the way, here's my invoice. Thanks, bye. They don't ask who they loaned the money to in exchange for corporate paper, or check to see whether or not their treasuries are rehypothecated, or ask how many times each of those 63 billion Tether tokens have been rehypothecated. Another issue with lack of regulation around stablecoins is how the reserve assets values are accounted for. In a regulated environment, the SEC requires financial institutions to use stable pricing conventions or amortization schedules of assets that basically track the value of the assets over time to ensure accuracy of the balance sheets. However, in the case of Tether and other stablecoin providers, they are not subject to those rules and can simply list the market value of assets at the time of purchase. For example, let's just say that a portion of Tether's reserves is in Bitcoin that was purchased at the all-time high of around $64,000, and that's how it's listed on their audit. So they could have 100 Bitcoin they bought at $64,000 listed as $6.4 million in reserves, when in reality, those 100 Bitcoin are now worth $3.3 million. And that same goes for the commercial paper. They could have bought a lot of commercial paper that is now in default, yet it's still listed as reserves at the purchase price of the paper, even though in reality, it's not worthless. This is why lack of regulation, especially around stablecoins, has created what we will discuss in the final chapter of this video series in the third and final video. In the chapter, we are going to pull it all together and explore why the structure of the cryptocurrency market could resemble a card house on the verge of collapse, courtesy of Tether, other stablecoins, lack of regulatory oversight, and the fact that its foundation is the inverted card house that is the current state of the traditional financial system. And finally, we will discuss different ways the collapse could materialize, as well as ways we could prepare ourselves to protect our investments. Until then, behold again the structure of the current traditional financial system that also currently serves as the foundation of the entire cryptocurrency market. Awesome. Congratulations for making it through chapter 2 of this video series. Yes, it was tedious, but probably a lot more interesting as an investor in the space because it's helping us all better understand and appreciate the current state of the crypto market so we can implement ways to protect our investments. This is the second video in a 3-part video series, so make sure to check them all out to get the full scoop. If you enjoyed this video, please make sure to like this video and subscribe to my channel for more crypto content. So what do you guys think about the current structure of the crypto markets? Do you think the Tether situation is old news and no longer relevant? Or do you think its prolonged, deep entrenchment in the markets could be detrimental to crypto? Let me know in the comments below. Be safe out there.